Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a oil and natural gas hedge fund manager of publicly traded companies over at Bison Interest. Josh Young, thank you for joining me again.
Yeah, thanks for having me back.
So, Josh, we're recording this on Friday night, May 19th, 2023. West Texas intermediate prices are a little above $70 a barrel, actually a little bit above $71 a barrel. Brent crude is a little above $75 a barrel, and U.S. natural gas prices have rallied substantially in the last couple of weeks. They're around $2.60. I want to get your thoughts, though, on global oil inventories. You've been talking about this a lot. While the oil futures contract falls, are global oil inventories falling a lot lately?
Yeah, I mean, it's pretty amazing how bad things have gotten in the futures market for oil. And there's sort of this amazing observation that, stocks and I guess also futures are one of the few things where when they get cheaper, people want them less. And when they get more expensive, people want them more. So you can look at this very simply, that the non-commercial net positioning for oil and oil-related products on NYMEX and ICE, we're down from 1.4 billion barrels of oil in futures contracts to, it looks like, about 100 million barrels in non-commercial net positioning. So we've seen, and this has been a trajectory for a long time, but even just this year, we've seen about 300 million barrels of of futures contracts sold, which again, you think about that. I mean, it's millions of barrels a day. Our mutual friend, Harris Kupperman, he observed that, I think it was last week, 6 million barrels a day of oil were being sold via futures, essentially dumped on the market. So it's not a supply issue. It's not a demand issue. It's a supply of paper that's being dumped onto the futures market.
So these are the global macro hedge fund So these are the global macro hedge fund bros, and I see them all the time on financial Twitter. They have large Twitter accounts, and they're like deflation, bankruptcy, short oil, short energy, short consumer discretionary. That seems to be the theme right now, regardless of any actual supply and demand fundamentals for the physical oil market.
Yeah, they say that, bulls make money long term, bears sound smart, and market timers go bankrupt. And so, one of the really interesting things in the last few years has been market timers launching active ETFs. And you get to see sort of how these folks who sound brilliant perform in the market. And it's pretty abysmal. I just take that. I like to fade those folks, essentially take the other side of those sorts of positions. And, the trade has been, it's been the Buffett trade. It's, you be optimistic on America and optimistic on the stock market and the economy. And when everything sounds terrible and is scary, that's when, you hide under your desk and click buy.
Well, there's only actually 4 or 5 stocks in the general stock market index. Those are the large cap tech stocks that are holding everything up. Pretty much a lot of the other companies in the other sectors are looking really, really bad. So the mainstream media, the mainstream financial media is promoting a few of the large cap tech stocks and talking about how the bear market is over. But beneath the surface, there's enormous amounts of problems. I mean, look in oil, like the paper futures contracts, like you said, are indicating one thing. They're looking at price weakness for oil. But when you look at the fundamentals, the headlines out this week, we're just seeing crazy stuff. Oil demand's at a record high now globally, right?
Yeah. And again, I sort of dodged the inventory part just because I feel like I've talked about that a lot before. But yeah, I mean, we're undersupplied right now, and we're going into a historic undersupply for the oil market in the second half of this year. Earlier this week, I attended a energy conference that a local investment bank here in Houston hosted, and got to hear Darren Woods, the CEO of Exxon Mobil, talk. And he was talking about how, among other things, that the oil market looks terrifyingly tight in the second half of this year, that there's just, folks don't know where the oil is supposed to come from to meet expected demand. So it's pretty remarkable to have that from, it's ExxonMobil, right? He talked about how he doesn't know what the oil price is going to be and how the way they orient their business is always oriented towards making sure any investment they make is economic, even in an oil downturn. And on the other hand, you have them, they're sort of like pessimistically oriented, and you still have them worried about where all of this supply is going to come from. So yeah, it's really remarkable. This is maybe the most extreme, maybe similar to, I don't know, November or October of 2020, where people they were talking about oil was going away, even as oil demand was surging. So similar sort of dynamic and similar pricing, both for oil as well as for oil and gas equities.
So you would say there's a big divergence between the paper oil futures contract price and the supply demand fundamentals then?
Yeah, absolutely. And there's always noise in the physical market. So people will pick up, oh, hey, there's a differential right now on this particular grade of crude in this particular spot, or this particular tanker didn't sell their oil this week, and everyone will echo those. And one of the things I've noticed in the last few years when I've started to pay more attention to this is that you hear those echoing the loudest right before very large oil price moves. So you'll see people broadcasting, oh, there was some physical oil problem. And, the reality is they happen all the time. It's similar to these train wrecks where like 3 train wrecks happen a day in the US, and we were only seeing them more on TV because there was one really big one that, they tried to cover up, and then suddenly people were made re-aware that there are these train wrecks. Well, similarly, there are all kinds of problems in physical markets. They're not paper markets. There aren't sort of smooth transaction mechanisms. And so, when you start hearing about these problems, that's actually usually a bullish sign, ironically, even though people try to paint them in a bearish light. But yeah, I think it's really remarkable with the general health of the physical market, the rapid depletion of inventories, including the Strategic Petroleum Reserve and Chinese strategic inventories, which are down significantly, and Chinese products inventories, which are down a lot. And I mean, it's just really remarkable strength. And we're not there yet, right? Like we're still seeing reopening. China still is 700 or 800 flights a day less international than they had pre-COVID. And, their domestic flights, I think, are above pre-COVID levels, as well as in many other parts of the world. And so we're in this weird situation where the flight count globally is higher than it was pre-COVID, but the flight miles are still recovering. Again, a lot of that's just international travel to and from Asia. And these tend to be really long flights that use a lot of jet fuel. And so we actually have a lot of room to go still for jet fuel demand, and then associated other gasoline and diesel demand around trips that people take internationally. And yeah, I mean, it's really you look at what is happening as well as what's likely to happen in the near term with demand. And I mean, markets are really tight, and it's the sort of situation and setup where it wouldn't be surprising to see oil at 100 here right now. I mean, it could just as easily be at 100 or 90 as it is at 70, with everything the same except different positioning in the futures market.
And China reopening has not gone very smoothly, but we're seeing headlines come out this week with stories on oilprice.com about China's refinery throughput jumped 19% in April, which I guess means you said their inventories are depleted and the refiners are stockpiling and starting to make more refined product, I guess preparing for more flights and more diesel usage and more transportation of with trucks and cars of the goods that are manufactured in their factory. But the other point, and this story came out yesterday on Thursday, was global oil demand hit a record high in March. Rising demand in China, United States sent global oil demand surging by 3 million barrels per day in March compared to February, hitting the highest level on record. Data from the Joint Organizations Data Initiative showed on Thursday. So normally in the past, Josh, wouldn't those types of headlines been good for the oil price? But it just seems like the global macro theme with the banks and the Fed rate hikes and the deflation and bankruptcy narrative, that seems, and in the comments from Home Depot this week about the economy slowing, those seem to be taking precedent compared to the potentially bullish headlines that we're seeing in the oil market.
Yeah, I mean, honestly, I think people just sort of make up headlines in the oil market. I think most of the time they have to have something, right? So they just say something, and a lot of the times they're not so meaningful. But when you look at this sort of general price level and trajectory, historically, the things reflected in some of those headlines would be reflected in price. And yeah, it does seem like there's sort of this weird combination of recession fears along with price movement driving narrative that's somewhat circular, that's been sending prices down and sort of promoting this sort of circular spiraling of negativity. And so, negative sentiment leading to lower price, leading to even more negative sentiment. And the exciting thing about it is, look, like people have talked about this happening in precious metals and in other sort of categories for a long time, but oil is a physical market, and the physical market, I mean, we're seeing giant quantities of oil being consumed out of inventories. And there are reasons to have things like a strategic petroleum reserve, and there are reasons to have commercial inventories, right? Like you want to have a few days of refinery capacity on hand at a refinery, and you want to have more in storage available in case there's any sort of supply disruption. And we just learned this lesson with COVID and all the supply disruptions around that, not for oil, but for almost everything else. And so, I think we're going to see, I think it could be a pretty big shock to folks as we go into this sort of higher demand period that we're entering. And then the one other thing that's worth mentioning, we are in a freight recession right now, right? We're seeing suppressed levels of diesel demand. We're seeing people shifting consumption, or not even shifting, they shifted consumption from goods to services over the last couple of years. People went from ordering Pelotons and various other faddish exercise equipment and other things online to going out and traveling and spending money at restaurants and bars and sports events. And I mean, you can see it all in the consumption data. And so, that's really hurt diesel demand, and it's sort of incrementally helped gasoline demand. As we sort of normalize post-COVID, there's a lot of room. And as we exit this goods recession, whenever that happens, right? Maybe it lasts for another month or a year. No one knows. But we know that historically we've exited recessions, and with our monetary and fiscal policy as loose and aggressive as we've experienced over the last number of decades, you sort of know it's just a matter of time before they hit the printing press in size. We will exit from it, and there will be more diesel demand. And we're already this tight in the oil market, even without that, and even without China having sort of fully reopened from an international travel perspective.
And the Saudi oil minister also said that if China comes back online to oil consumption levels, I believe at 2019, so before the pandemic, he said that OPEC and the Saudis have no spare capacity. He said the global oil market just couldn't handle it if China came back online to pre-COVID levels.
Yeah, it's the most remarkable thing. I was making bone saw jokes around when we put out our OPEC plus spare capacity white paper. I guess it was a couple years ago at this point. And within a month of our white paper on, the myth of spare capacity in OPEC, the Saudi energy minister and I think the Russian energy minister and the second in charge of Aramco, they all came out and said, yeah, they weren't addressing, I don't think they were responding to our white paper, but, they all just admitted that there was a spare capacity issue. And so it's this weird thing where there are various, investment bank analysts and a number of now hedge fund managers who feel strongly that there's this giant amount of spare production capacity for OPEC plus. But you look at the actual production, oil prices spiked, right? They went to 130 or so a couple of times last year. And when you look at supply historically has been when there's been spare capacity, it's been pretty responsive to price. And we did not see a flood of supply last year, despite the spike in price. So I think we sort of saw more or less what the available production capacity was last year, and it's not inspiring. I agree with them. And the one other really interesting thing that I think people just haven't been paying enough attention to is that historically OPEC was not encouraging oil exploration and development outside of OPEC, right? They wanted to maintain market share, and they certainly weren't on the bandwagon of trying to encourage people to develop, let's say, the North Sea or develop Alaska or various other places. That they're out there repeatedly telling people to go drill more. Like, not in Saudi Arabia, they're telling people in the US to drill more and in Canada to drill more. And they're saying that there's massive underinvestment across the industry, and people are just not listening to them. It feels like a very weird situation for people to just ignore the largest oil producer, or one of the largest oil producers in the world, and one of the largest oil exporters in the world, telling us that there's not enough investment. I mean, it's not in their interest to tell us that unless there really is going to be a really significant shortage. So I don't know. I mean, I think there's no incentive for them to lie about that. And, it's very, very bullish, and it makes it extra weird that so many people are selling their oil futures, cutting their exposure, and in many cases actually going and shorting oil or oil related equities.
Well, a lot of these hedge fund managers, professional money managers, are so short-term oriented. I mean, they're looking at their returns every week, every month, every quarter. So they're not thinking 6 months, 12 months, 18 months, 24 months out that, oh my God, if oil prices go a lot lower, we're going to have a similar repeat to the cycle in 2020 and 2021 where a lot of supply comes offline. Then we're going to have another big oil spike again. So the short-term money managers that are myopic and short-term oriented with their returns because they don't want to have assets under management just flood out, they're not thinking about any of those things that we might have another problem here if oil prices continue to go lower, that more supply is going to come offline, or OPEC maybe announces additional cuts. But Josh, isn't oil production from OPEC? I mean, the April survey data came out a couple of weeks ago. The oil production from a lot of these OPEC plus countries, Saudis don't even have to announce cuts because production's falling on its own, right?
Yeah, exactly. That's what they're telling us this, right? So you'd think that we would listen, but instead we're, dropping oil rigs and from a policy perspective, discouraging investment and actively selling oil futures in the market. So yeah, it's pretty weird and pretty unfortunate. But that's the reality. So yeah, I think, and in terms of short-termism, I think it's really interesting. Like I get a lot of pushback, right? Because I invest in volatile, generally small and mid-cap publicly traded producers in a sector that's volatile. So there's like twice the volatility, I'd say, that you normally would experience in an equity strategy, and maybe 3 times because it's also small cap producers, but over time have done really well. And so it's one of these very weird things where people, they don't like the price volatility, or that, hey, maybe they're going to be down in a month, but, we have like 8 years of returns, and we've, and this isn't an offer for the fund or anything like that. Just highlighting exactly this sort of weird disconnect. We've destroyed our benchmarks and so much better. And people would rather go own an ETF or a fund that claims to be able to do better in the short term, but over that sort of 8-year period, maybe did a lot worse. It's just a very strange, very short-term oriented and sort of myopic approach where, I think there's, when you have room to breathe, when you've outperformed, when you have a lot of your money invested and longer term money alongside you, I don't know. I think this just looks super attractive. And I think, to your point, I think the folks that are betting against oil here do seem to be very short-term oriented, and ironically, they might have the 1,001 days in the life of the Thanksgiving turkey problem, where 1,000 days look good, and then that 1,001st day is pretty devastating. I mean, oil is setting up for that, and that's another thing the Saudis have said repeatedly, is that they want to hurt people who are betting against the oil market. And I know it's like sort of aggressive, and but it's worth thinking about. I mean, they're telling you they want to hurt you, and this is how they hurt you. If you're short-term oriented, that you have a very negative P&L month or year from oil prices rebounding substantially. And it's just so strange that people would want to get into a market with this sort of one-sided positioning and bet in favor of that one-sided positioning. I mean, it's just so bizarre. And it's the sort of thing, when I see this, I get more excited, and I just go find things that give me even more exposure to when this works out. And historically, being that sort of contrarian, you look really stupid and really sort of oddball for periods of time. And the stupider you look and the more eccentric you look over those periods of time, the better you do after. So I don't know. I'm sort of excited about how this plays out, but it's also, honestly, a little frustrating in the meantime.
In terms of valuations with price to earnings ratios, are you seeing lots of bargains with these small and medium-sized oil companies in the US and Canada?
Yeah, so price to earnings is not a good metric for oil and gas producers for a lot of reasons. That has to do with sort of how their accounting ends up working, especially if they have financial derivatives or other sort of obligations that can get their gap just doesn't effectively represent or illustrate sort of their business performance. But yeah, on measures that make sense for the industry, which are discounts to prove producing reserve values, free cash flow yields, replacement cost, and so on. I mean, it is astonishing what you can get in the market these days. And in many cases, you're buying companies, at least on our numbers, we're buying stocks at a fraction of what their current liquidation value is. And that current liquidation value is heavily discounted versus historic. And, the biggest example of that is just, you look at some of these low decline producers, and, assets that had a 10% or 15% or 8% or whatever decline rate in 2012 to 2014, oil fields would sell for $200,000 to even $250,000 per barrel of oil produced per day. And these days you can buy some of those companies for $20,000 to $40,000 per barrel of oil produced per day, in terms of their enterprise value versus that production with those same sort of decline rates. So it's really, that's a huge discount, especially when you consider how much inflation there's been and how much other assets have appreciated. If it just appreciated on track with housing, for example, housing prices in the US are up 50% or something since 2014, or maybe more. I'm not sure exactly what that number is, but if it just appreciated in line with housing, you'd be looking at, let's say, a price of 300 or 350,000 per barrel of oil produced per day for a low decline field, and instead you can go buy those for 20 or 30,000 via some of these stocks. So yeah, it is just an absolute steal. And there are good reasons to want to own low decline producers. You don't have to spend very much to sustain production. They generate lots of free cash flow. They're very durable. And, in many cases, they can produce for decades into the future. So you have these just very sort of stable production streams, and the cash flow is variable because at high prices you make a lot, and at low prices these tend to have higher operating costs, so you make very little, if anything. But over time, the free cash flow, sort of the area under the curve for those sorts of assets, are very attractive because of the low reinvestment requirements. And so, just absolute steals on the equity side.
So you talked about the decline rate. Excuse me. I've heard a lot of people in the oil industry talk about the recycle ratio and netbacks. Do you also look at those, or are those similar to the decline rate?
Yeah, similar sort of idea. So a low decline producer, let's say that you're declining by 13% a year, you only have to reinvest to drill to generate additional production to replace that 13% of production you lost to keep production flat. So generally, a free cash flow measure would be what your operating cash flow looks like after paying your interest costs and so on, but also spending the capital necessary to maintain your fields and to increase production to level out relative to the decline. So 13% would be really low. There are some companies that have 50 or 60% decline rates where before they can grow, before you even start counting any free cash flow, they have to reinvest to be able to essentially grow their production by 50% or 60% just for their production to be flat. So, the free cash flow measures are pretty interesting. And free cash flow yield, for example, is not the world's best metric either for oil and gas companies, even though it sounds really good and you do want free cash flow, but it doesn't always tell you everything that you need to know, because a really attractive free cash flow yield at, let's say, $80 oil could be nothing at 60. And it doesn't really tell you a lot. Whereas, a company, let's say, that had a lower free cash flow yield at 80 might still have a pretty good free cash flow yield at 60 if they have a much lower decline rate. So they just don't need to spend the money to sustain production over low price periods.
Yeah, people in the oil industry, they use the term recycle ratio netbacks for our listeners out there. So those are industry specific terms, but those have to deal with what decline rates and how much capital the company has to reinvest to maintain production levels. Because if the recycle ratio is low, that means that the company's not getting good return on investment. They're not able to grow production. They can't spend on growth capex. They have to spend on maintenance capex because, like you said, the decline rates at the wells are so enormous. They have to spend. It's like these shale drillers, like Pioneer Natural Resources and these others. They're going to have to spend many billions of dollars to maintain their production levels at these shale wells in the Delaware Basin and the Permian that decline at rapid rates.
Yeah, yeah, and netbacks are it's another way of describing margins, like operating margins. So yeah, same idea. I think you got that right.
I want to get your thoughts actually on the Permian Basin. So do you think that the Permian Basin is close to peaking or has already peaked in terms of its production?
I do not. And I know that's sort of a increasingly popular view. I think there's a lot of oil left there. I think oil production there, I mean, it may peak temporarily if if rigs keep falling. The rig count for oil rigs is down substantially year over year, and I think down even more substantially from its peak. I think it might have peaked late last year. So we need more rigs running to grow more, but I think there's more production capacity there. You just need higher prices and more activity to get more production out. So I think well productivity on an incremental well basis is down, but just because you go from A+ well to an A- well as your next well doesn't mean that your overall production is necessarily going to decline. So I think there's questions around rate of change and there's questions around capital intensity. But I do think, look, if oil was $150 a barrel and it was that for the next 3 years or 5 years, 5 years from now, if it was 150 for that whole time, you'd have way more oil production in the Permian than you have right now.
Yeah, I agree. A lot of it's about free cash flow and how much capex the company needs to spend. So if the oil price continues trending lower, the company has less free cash flow. They're looking at cutting their variable dividends, going to be down a lot. If the company has debt, they have to focus on that and clean up the balance sheet. So you're just not going to see as much growth capex spent then. Obviously, they have to spend on maintaining some capital. But if they're natural gas, they have a lot of natural gas wells. They're going to be cutting that supply and not investing in new natural gas wells, though, with the price.
Yeah, for sure. And then, natural gas and NGL prices actually have quite a bit of an impact on the profitability of Permian wells, even wells that are supposed to be oil wells, because the percentage of oil declines and the percentage of natural gas and NGLs increases generally for these wells as they get older. And so that affects the profitability, especially because of the high initial decline rate. So the gas tends to decline at a much lower rate than the oil. And so when you look at sort of the total production out of a lot of these wells, many of them end up producing a large quantity of natural gas. So low natural gas prices are really hurting the cash flow and likely the activity levels in the Permian. But that being said, I guess just the one thing that there's a nuance there, which is what we were seeing in the shale boom from 2010 to 2020, essentially, or at least till 2018, was there were improvements in well productivity. So you could go and your next well would be better than your last well. And when that's happening, you're sort of forcing down the marginal cost of production, and you're better off as a sort of growing producer in that environment because you're on the bleeding edge. Your incremental production is lower cost than your old production and lower cost than other older production that you don't own. In this environment with declining well productivity and frankly declining well economics on a sort of flat price perspective, there hasn't been the same sort of investment in exploration or in technology, and we're sort of hitting the limits on some of the efficiency gains that we've been able to, as an industry, pull together over the last number of years. I think we're going to see, because of that, there's a different environment that just it's not as conducive to large amounts of capital investment. So that's sort of I don't know if I explained that well, but that's sort of the other overlying aspect that's keeping production from growing a lot. But it doesn't mean that there isn't a lot more to go. And it doesn't mean that there aren't a bunch of great wells to drill. It just means that the next well is probably worse than the last well rather than better. And there are a lot of implications from that.
So why do you think then that Chevron or Exxon, well, the rumors are ExxonMobil then is looking at Pioneer Natural Resources or another large producer in the Permian? Then if you think then that there's not a lot of capital activity, you think that on the valuations, they're looking at what you said earlier, that the cost of the amount of oil production per day, the valuations on that, that's why ExxonMobil is looking at buying a lot more Permian assets?
It's a good question. They haven't actually bought, so I don't know if they'll buy Pioneer. I think they denied it. And I think Pioneer might have. I know there were other rumors about Pioneer buying a natural gas producer that were denied too. I don't know. We'll see. I think the larger cap producers are not nearly as cheap as the smaller cap producers. So my comments were more geared towards the smaller caps where their valuations are far lower on the metrics that I shared. But I'm not sure. I guess we'll see what Exxon does. But they haven't done it, and even though it's been rumored, it doesn't mean that they're necessarily going to go and spend the money they spent. The flip side is that when you look at the past few oil and gas cycles, Exxon did buy the top. So,
oh yeah, the XTO acquisition was horrible.
Yeah, and then the mobile merger was really tough, and you look at how that stock did for a number of years afterwards, and it did not do well on that as well. And you look at prior cycles, and the return on invested capital for the entity was amazing historically, and it really it took some big hits from bad large deals over the last couple of decades, and so I don't know what'll happen, but I really like their CEO. I think he's really smart and had a lot of good things to say. And so I think I'd like to think that they don't go do something stupid. Maybe they'll go buy 10 smaller producers for 2/3 of the price that they would have paid for Pioneer and get the same production and inventory and reserves.
Do you think that the smaller producers like Journey Energy are going to be more aggressive looking at some of those valuation deals that you described earlier in the interview?
Yeah, I mean, Journey has a 13% decline rate. I own it. I'm not recommending it, but it's I own a lot of it, and I'm really excited. And Journey is also interesting. I try to find companies like Journey where they're cheap on just the easy metrics like production and the valuation on low decline production per day, but they also have this power business. And I've talked about it for a while. And people sort of, I guess, don't believe it at some point, but they have 4 megawatts of power gen right now that they're ramping to 36 by Q1 of next year. And so that power gen is worth in recent transactions arguably around $5 million a megawatt. And their market cap is around 300 or so, and they have sub 100 million of debt. So they're getting to the point where just their power business is worth a good portion of their total valuation, and they're growing their power business by over 100% a year annualized. And there's a lot of opportunities to keep growing it. And Alberta is grossly misallocating capital and resources in their grid towards unreliable solar and wind. And that's a great opportunity for natural gas power generation, like what Journey is developing, where, they can just turn it off for the 8 hours a day where the sun's shining, or the 2 hours a day where the wind's blowing really hard, and then make tons of money the rest of the time selling into the grid.
I call ESG energy spending grift. So yeah, it's policy misallocation in DC and the major governments in the Western world.
Yeah. And, you can complain about it or you can make a lot of money on it. And I think I prefer the way that Journey's making money on it, which is by helping essentially back up the grid. And, so far they've seen some really interesting things in terms of power prices spiking. And, it's actually, I think that problem, unfortunately, is going to get worse. It's especially stupid in places like Alberta, where the sun, it's not that sunny for large portions of the year, where there's a lot of snow and, where wind is really unreliable. And, the policy failures of the Canadian government and the local provincial government are to the benefit of those who are willing to take the risk and invest. And then for Journey in particular, they're very well suited for this because they have these low decline relatively high cost natural gas fields. And so by hooking them up to power generators, they essentially extend the economic life of those fields. They push out abandonment liabilities, and they just have this sort of win-win-win situation. And they've been buying used power generators that are old but very gently used, and just getting excellent deals, refurbishing them, installing them. And their first one, people thought it was crazy. They bought, I think, a 20-year-old generator, and it's working great. And so I think they have a really good model for it.
I really enjoyed our discussion today. You are a wealth of information on oil and natural gas. Please tell my listeners about the free newsletter you have over at Bison Interest.
Sure. Yeah, we put out a roughly monthly white paper. We have a letter from our investment management company, which again, I'm not soliciting for, but if for accredited investors, they're welcome to just go to bisoninterest.com and sign up for our letter describing sort of what we're up to, as well as sharing our insights. And then we started a Substack just to share other industry thoughts and investment ideas and so on. And so if you find our Bison Interests Substack, that's also available. It's free, and we're happy to sort of share some of the stuff that we're seeing.
Just crazy times in the oil market, though. I mean, in the short term, with these global macro hedge fund bros shorting everything, we might go a little bit lower. But I think a couple of years from now, Josh, we're going to be talking again about another spike in oil prices, because it looks like the divergence between the paper oil futures contract and the supply demand fundamentals, it looks like the distortions and the divergence are just getting even wider.
Yeah, I can't wait to be told that this was obvious.
Just like OPEC production, how you were warning people that OPEC production was going to have problems way ahead of time. And then CNBC started talking about, I think, 12, 18 months later without citing any of your charts.
Yeah. That's sort of the joke, right? Like we're cheating and using a time machine to write the Wall Street Journal and Bloomberg articles a year ahead of time. So similar idea. I'm sure people will say, "Oh, it was so obvious," and how could you not own oil or oil stocks when net positioning was this low, and it's such an obvious thing. And of course, oil was going to spike ahead of a recession. It always does. And, people just treat this as a given, and we're sharing this, and people just think it's crazy and irresponsible and all kinds of different descriptions, when it's just, I sort of don't care. I just want to be right. And, I do the analysis, and the analysis is saying that oil prices are going a lot higher.